Good morning to all, and thank you for joining us. My name is Soledad Martinez Peria. I'm an assistant director at the IMF. I'm privileged this morning to chair the second session of our three-part series event on central banking and inequality, COVID-19 and beyond, organized by the Peterson Institute for International Economics, the International Monetary Fund, and the Council on Economic Policies. The session this morning will focus on the role of financial infrastructure and its link to inequality. As we know, COVID-19 has hit some sectors and communities more than others, and this can have long-run implications on inequality. In fact, in a recent speech, Jerome Powell recognized just this and stated that the pandemic is further widening divides in wealth and economic mobility. While fiscal authorities wield the most instruments to tackle inequality, this panel will be devoted to discussing the role that central banks, as the authority that oversees payment systems and financial institutions in most countries, as well as, of course, runs monetary policy, can play in reducing inequality. In this case, by promoting the development of financial infrastructure and fostering financial inclusion before, during, and after COVID. To discuss these issues, we're privileged to have four great speakers who have written extensively in this area. Camille Busette is a senior fellow in governance studies with affiliated appointments in economic studies and the metropolitan policy programs. She's the director of the Race, Prosperity, and Inclusion Initiative, Brookings cross-program initiative focused on issues of equality, race, racial justice, and economic mobility for low-income communities and communities of color. Our second speaker, Luiz Awazu Pereira da Silva, is the Deputy General Manager of the Bank for International Settlements. In his role as Deputy General Manager, he has given many speeches and done substantive work on financial inclusion and financial innovation. Our third speaker, Leora Klapper, is a lead economist in the finance and private sector research team of the Development Research Group at the World Bank. She's a founder of the well-known Global Findex database, which measures how adults around the world save, borrow, make payments, and manage risk. Leora has had many publications related to financial inclusion. Finally, Professor Robert Townsend, he's the Elizabeth and James Killian Professor of Economics at MIT. He's also a distinguishing research fellow at the Becker-Friedman Institute for Research in Economics at the University of Chicago and a research associate at the National Bureau of Economics. Among other important seminal work, Professor Townsend is known for his work on insurance and credit in developing countries. So let me set the ground rules for our discussion this morning. Each speaker, in the order that I've introduced them, will have make an introductory remarks for 10 to 12 minutes. And then after all of them have spoken, we will take questions from the audience. So to pose questions, please post any issues you want to discuss in the Q&A chat box, and I will be monitoring that throughout this morning and make sure to try and get to your questions after the speakers have presented. And hopefully we'll be able to cover most of the questions because we've left around 30 minutes for Q&A. So without further ado, now let me give the screen to Camille, and thank you again all for coming, and looking forward to a great discussion. Camille, the screen is yours.
Thank you, Soledad. Thanks for that introduction. It's a pleasure to be here. Good morning, good afternoon, and good evening to everyone who has joined us. It's an incredible pleasure to be here, joined by my also illustrious colleagues on this panel, and I'm very much looking forward to the discussion. You know, every time we have a financial crisis or a recession, we learn anew about the ways in which the financial infrastructure does and does not support the most vulnerable households. This particular pandemic recession has been uniquely abrupt and deep and has affected the most vulnerable in multiple ways that have an impact on household finances. For instance, lost jobs or the inability to work, illness, and depending upon where you live in the world, it could also mean significant medical debt. We have already seen that hunger worldwide has escalated across the globe as a result of this pandemic recession. What I wanted to do is talk a little bit about what's happening in the US. The Gini coefficient in the US is 0.48, and that puts the US at 40 in the list of inequalities across the globe. The racial wealth gap in the US for household wealth is 8-to-1 white household wealth to Black household wealth. In the US, the impacts of the COVID-19 have been worse for marginalized communities and for poor women, as Jerome Powell has mentioned. The financial infrastructure in the US has been, in my view, ill-prepared to support the most vulnerable Americans, largely because the efforts to ameliorate the impacts of COVID-19 have depended on congressional action, that's fiscal action, and the levers available to the central bank in the US, the Federal Reserve, are very few, and the uneven distribution of banks in the US, where low-income areas are usually not served or poorly served by banks, all lead to a picture which is not particularly helpful for vulnerable households. So let me start by giving a quick review of the actions that were taken by the Fed, the US Treasury, and the US Congress to initially blunt the economic impact of the coronavirus. So Congress passed 3 major relief bills in the US, which were intended to keep businesses and individual households afloat for a 3 to 5 month period. This was at the outset of the pandemic in the US. Among the elements in these plans were stimulus checks and a business loan program administered by the Treasury Department. The Fed also stepped in and, among other interventions, opened multiple lending facilities, primarily for corporate and municipal lending. And the Fed also used its substantial bully pulpit to advocate for congressional action on behalf of US households. And I'm going to review each of these in turn because they are interlinked to the financial infrastructure question. So stimulus checks were either deposited into accounts that taxpayers had used to receive income tax refunds, or they were sent to the last known address of record for the taxpayer. The stimulus check administration was effective in pumping money out quickly, but the households that had not paid taxes in the last 2 years, which are often lower income households, there was a very onerous process of sending in your information in order to get your checks or to get the money. Physical checks went to those without bank accounts on file, and those checks were sent out last, about 3 months after the start of the stimulus program. So what we learned here was that using tax filing records was probably not the most effective way of reaching low-income, non-tax filing households. The business loan program, known as the Paycheck Protection Program, or PPP, was an attempt to loan money to businesses in return for those businesses keeping employees on the payroll. And there was a role for the Fed here in guaranteeing some of that money. The loans were funneled through banks, which acted as the intake and approval mechanism for the program. So the program was largely unsuccessful. Laborious application processes favored large firms with accounting departments. Small firms, which are most common in Black and Brown communities in the US, typically did not have the resources to file those applications. Relying on banks to make decisions about which firms met the criteria and which did not, plus a certain dollar threshold for each bank in terms of its ability to approve lending, meant that banks simply went with their customers and businesses with whom they already had a relationship. So again, if you were a minority-owned business, meaning a Black or Brown-owned business, you were likely not to have that relationship and likely not to be favorably considered. So relying on banks also meant that communities of color where banks are sparse meant that there were fewer institutions to serve those businesses. And finally, the terms of loan forgiveness were at first unclear and later changed, which also confused small and micro business applicants. And the last issue was that Treasury ended up having problems processing the volume of applications that came through. So the lesson here is that the Treasury Department was ill-equipped to deliver this program, even though it was guaranteed by the Fed, and was ill-equipped to move the money where the need was greatest. Now let's talk about Fed actions. So let's remember that the Fed doesn't have the tools to reach down to the level of the household. The Fed relies on transmission mechanisms that allow its broad policy postures to be transmitted through the economy. As a result, the Fed could really only open up lending lines to corporations and to states and municipalities. And each of these borrowers are employers and can affect the lives of households employed by either the corporate or public sector entity. And in addition, state and municipalities can borrow to facilitate spending on social programs. The Fed facilities to corporations were used, but this did not have a large impact on inequality. The Fed facilities for state and municipal lending were underutilized because the interest rates were high relative to the time for repayment and for the projections on tax revenue in those municipalities. The Fed bully pulpit was important in focusing on the unequal impacts of the COVID recession on communities of color, the poor, and poor women in particular. And that was helpful as municipalities tried to launch social aid programs, but the bully pulpit was less effective in getting Congress to act with urgency and at levels that signaled an understanding of the scale and the depth of the devastation of household finances among the poor, low and middle income households in the US. So there was in addition to that, we also saw in the US a booming stock market while real household wealth declined. And so inequality likely has increased. We haven't measured that, but it's likely increased because of the devastation in poorer middle income communities, but the uptick in capital gains and gain from the rather vibrant stock market after May or June. So in the US, the financial infrastructure was in fact overwhelmed by the abrupt nature of the downturn, its sheer scale, and by reliance on systems that were not appropriate for addressing inequality. And the Fed in particular tried very hard to leverage its bully pulpit muscle, but in the end, that does have limitations due to the way things are just set up in the US and the reliance on fiscal measures. So in fact, inequality in the US has likely increased as a result of the COVID-19 recession. And with that, I'm going to pass the baton back to Soledad.
Thank you so much, Camille. Thank you for a great presentation discussion. So let me give the floor now to Luiz for his presentation. Luiz, you have 10 to 12 minutes.
Thank you, Sole. Thank you for the invitation, and very happy to be here in this very high-level panel. Let me share with you the presentation that I prepared. So this is about monetary policy, technology, infrastructure, and inequality, work done with colleagues of mine at the BIS, but we are expressing our own views here. And let me see what I'm going to talk about. First, why is it that monetary policy and inequality should be linked? Why do we bother? How particularly infrastructure can improve inclusion and therefore reduce inequality. Alert to the fact that you could have some technologies that can also increase discrimination and therefore inequality, and perhaps at the end how to balance precisely public policies to promote inefficiency and equity. To begin with, and to come back to Camille's initial points, the conventional view for monetary policy is that with the existing mandates of central bank, you already are doing the job by smoothing business cycles and reducing the length of recession. You don't necessarily need to do more if you believe that you are living in a world where the divine coincidence holds, because by stabilizing inflation and doing your job as a central bank, you are already contributing to address inequality. But if you think of a situation, and I think COVID-19 is particularly illustrative of that, where monetary policy may affect wealth and income inequality through a financial channel, for example, the prices of assets. well, then you have implications for the effectiveness of monetary policy, particularly if you think not of homogeneous representative households, but you think of a world populated by heterogeneous households that would respond differently to monetary policy decisions. And then you might think that inequality that Camille was describing in the US does have an effect on the monetary policy transmission. And an illustration of that, I think Camille was talking about inequality rising in the US. You have on the left, by states, across US states, the increase in the percent income share of the top decile of the distribution. You can clearly see that from the mid-80s, it has been rising constantly. Now, one effect of that, when you look at, let's say, what Camille was referring to in terms of the recession brought by COVID, but it is also true for the global financial crisis, the GFC in 2007, 2009, you can observe on the right panel that if you are in a more unequal US state measured by private consumption growth and the income share of the top 5%, the effect of the recession brings steeper declines in US consumption. So in a sense, you are already in breach of the homogeneous effectiveness of monetary policy. What is valid for the US, it's also valid for the world. Here we are trying to measure the recessions in several sets of countries by level of inequality. And you can see on the left that recessions in more unequal countries are steeper. This is a result that I was showing you for the US for private consumptions. If you belong to, let's say, the green, the sort of the higher inequality countries, the depth of the recession measured by private consumption falls is much deeper, almost twice as much as if you are in a more equal country, the sort of the yellow column, where you do have a fall on private consumption, but at a lower degree than in more unequal country. We did some economic work for 20 advanced economies measuring the effect of expansionary monetary policy in terms of the effect on, again, consumption growth. And you can see on the right that if you are in a country with higher inequality, these are the sort of the darker little dots, you are measuring the central estimate of the private consumption response to a monetary shock. And you can see that if you are in more unequal countries, the cumulative effect on year 1, year 2, and year 3, the darker dots are much lower than if you belong to countries where you have a more equal distribution of income. And this, of course, has to do with the fact that in more equal or unequal country, you have a higher proportion of wealthy households with a lower propensity to consume, marginal propensity to consume, and therefore a smaller effect of your monetary stimulus. Now, can technology and particularly infrastructure solve a bit of this transmission problem in the effectiveness of monetary policy? Well, you can say yes. I mean, you have examples of this positive impact of the new technologies and new infrastructure. Think of India, for example, the Aadhaar digital ID that have allowed in about 10 years, this is the red arrow in this graph, for India to access at a much faster rate bank accounts for a much larger proportion of its population. This is the jump from 2008 to 2017 for India. If India had waited for the normal growth process, instead of about 10 years to reach 80% of bank account access, it would have taken about 47 years. What is valid for digital ID and this type of infrastructure is also valid for mobile money. You can see it's not only South Asia, the dark line that has increased progress in terms of accessing bank services. It's also valid for regions such as Latin America and also Sub-Saharan Africa and so on and so forth. And technology and the infrastructure can also allow for much faster real-time payments. This is happening now with fast payment systems that are being put in place in many jurisdictions. It's following the RTGS real-time gross settlement systems that we put in place in the past for wholesale payments. But you have also a similar phenomenon that is now facilitating poor households and increasing the speed for smaller financial transactions, which is also an element that facilitates their life at a lower cost. Financial technology has also, as I think you probably have seen, reduced the cost of migrant workers' remittances. You can see here in the yellow line that the cost in percentage of the remittances, particularly for smaller, poorer households, has been much lower than traditional means and costs of transferring money cross-border by banks, for example. This is the red line, and you have also technologies such as the ratings of credit risk by new big data technologies have been increasing the access to credit for higher risk households and for SMEs. These are the representations of the probability of defaults using the traditional credit bureau types of measures of risk, and this is the blue lines and the three major categories of broad low risk, medium risk, and high risk. And if you use a more granular type of modeling of default risk by fintechs, the red dots, you can see that there is more differentiation of defaults. And one important aspect is that this differentiation allows fintechs to lend in the sort of the right side of the graph, which is the high risk areas. 30% of these fintechs, and particularly one of them, Mercado Libre in Argentina, has been lending for this higher risk categories, where there was no bank lending whatsoever in this type of borrower in Argentina. So this, for example, answers one of the questions that Camille was referring to in terms of the effects of credit ratings on poor households. The technology also allows for a better prediction of probabilities of default. These are measures by the relative position to a receiving operating characteristic curve that measures basically how good is the predictive power of your model, which means that how you sort of rate the true positive rates of defaults to credit vis-a-vis false positives at various thresholds settings. And you need to be, of course, better than just a straight line, which is a kind of random model where you have a 50-50 probability of finding a false positive vis-a-vis a true positive. And you can see that the traditional bureau credit scores that are used by traditional lenders, the yellow and the red curves, perform worse than a model, a machine learned model that uses big data. Again, this is a Mercado Libre in Argentina result, which then has a sort of a better prediction of true positives versus false negatives. And of course, if you have a better way of differentiating defaults, you can, of course, increase the outreach of lending in your jurisdiction. Now, of course, these are all the positive aspects where technology can improve inclusion, can improve access, can reduce or can be more granular in defining risk premium. But you have also some caveats. And this is, for example, the change in the default probability in US mortgage markets, measured with traditional models and comparing it with a more sophisticated machine learning based credit scoring. Now you can see on the left that the models using big data and machine learning all of them have predicting a lower default probability. But when you look in more detail about which categories of society, of groups in society, the improvement goes to, everybody wins. But you can see that, for example, some specific groups such as white, non-Hispanic, and Asians are winning or are getting more benefits than other specific groups, such as the white, Hispanic, and blacks. Compare the red lines to the, for example, the blue lines. So there is a possibility that these technologies are perhaps bringing some degree of discrimination in the distribution of benefits. We know also that the inequality in returns to wealth is a reality. This is data from Italian households. You can see that households in the top distribution, top deciles of the distribution in pink at the top have a higher financial return. You can also see on the right that this is the effect of remote banking access on financial returns, and it can clearly be seen that the top deciles or the top percentiles of the distribution benefit more in terms of their financial returns from remote banking than the poorer households in the distribution. Another effect is the skill premium in the technology market. We have observed this in, remember, in the banking sector in the 80s and 90s. This on the panel on the right is also showing that US wages in the tech sector have been rising more rapidly than in other sectors of the economy. So this can sort of reinforce inequality through the well-known skill-based technological change. You can observe also in the left panel that this corresponds precisely with the very well-known rise in the value share of big techs in the overall stock index. And finally, on its own, fintech and those technologies and those types of new infrastructure have not necessarily been capable of closing the gender gap. You can see that the male participation on fintech products and service in all countries that are listed in this graph is much higher than the female participation in the usage of these fintech products and services. The red squares are much higher than the blue dark dots, which corresponds to the female utilizations of these services. So in conclusion, I think The monetary policy should be concerned with inequality because it affects its own effectiveness. This has been something that in the recent Fed review was very prominently featured, particularly when you begin using heterogeneous agent models, because you have a financial channel and you have differences in transmission. We have empirical evidence about that, and this is being reviewed by central banks. The new financial technology can certainly help inclusion. I think this is very important, particularly when you have crises such as COVID, but it can also bring some form of discrimination depending on the way it is used, depending on the way technology is being accessed by all or by only a few, and depending on whether technology is a substitute or a complement to labor. We know that this is a difficult assessment in terms of how this would impact long-term trends on wages, because you have many effects being combined here. You have the digital economy, you have demography and the supply of labor, and you have the way in which all this would impact savings. So in other words, for technology to promote inclusion, I think it should think of complementarity with labor and also of it as a public good with a broad and wide diffusion across all segments in society, with more competition and less rents. And perhaps it is necessary to think of it, to be thinking of it as a public good, to have some degree of reflection about regulation. Finally, these new technologies, particularly in the infrastructure of finance, may also help the efficiency of other policies. Think of, for example, the way in which we operate fiscal policies. And if we have now the capacity to identify digitally new IDs of specific groups that you want to target, for example, through CCTs, conditional cash transfer programs, if you want to have speed of transfers. And for example, of course, with COVID, you do need speed for addressing social issues. Then if indeed these technologies in the field of finance can help a lot. And of course, if you add all this with better policy coordination, it can certainly increase the overall efficiency of public policies. So, Soli, I stop here. Thank you.
Thank you very much, Luiz, for a very comprehensive discussion. So, Leora, if you can, now the screen is yours. Leora?
Yes. Hi.
Hi.
Okay.
Sorry.
I'm sorry. Let me begin. So thank you. In the summer of 2019, I interviewed this woman living in a village outside Mumbai. Even though she had a bank account for receiving government safety net payments, she didn't use it for routine transactions. She still preferred to pay a 50 rupee bus fare into the city center to pay a 350 rupee utility bill in cash, because she didn't know how to use the app on her phone, and she didn't trust that the money would go through. The economic and health crisis caused by COVID-19 threatens to wipe out the hard-won gains into global development and gender equality, and governments are scrambling to contain the economic damage. The practical challenge of quickly getting financial support into the hands of people who lost their jobs amid the economic crisis has challenged both advanced and developing economies alike. Cash can be unsanitary, and physical distancing measures makes it complicated to wait online. So we're seeing a quick shift to digital payments. And some developing economy governments are using mobile phones to provide contactless relief payments. For example, informal workers in Morocco are receiving government help through their phones quickly and efficiently. And according to the State Bank of Pakistan, the number of registered mobile banking users during COVID-19 reached about 9 million, an increase of over 40% over the year. And the number of internet banking users grew 25% over the same period. We're also seeing more private sector salaries being paid into accounts. For example, many apparel factories were forced to pay workers electronically during the COVID-19 lockdowns, when workers returned to their villages, and are continuing to pay their workers electronically to avoid the contact and expense of paying in cash. In Bangladesh, for example, over 1 million workers started receiving digital wage payments during the pandemic. We're also seeing a surge in digital remittance payments being sent home by migrant workers. But if past research is any indication, most recipients will prefer to withdraw the entire sum in cash. And the crisis has also shown that digital financial inclusion cannot rely on the cash out services only. Banks and mobile agents can close, ATMs can run out of money. To reap the developmental benefits of digital payments and the health sanitary benefits during COVID, a resilient digital financial system requires both inclusive account ownership and a strong financial infrastructure so recipients use their money in their account to pay their bills, purchase food, and send money home to family in need. I collect a huge database of indicators of financial inclusion called Findex. Every 3 years, we interview adults in over 150 countries and ask people how they save, borrow, make payments, and manage their risk. Importantly, the data is a representative sample of all adults, and the data can be diced and spliced by various individual characteristics, like gender, age, rural residence, and household income. Governments use these numbers to inform policy for inclusive growth of financial services. For example, how many poor adults have an account as compared to wealthier adults, or how many women use credit as compared to men. We identify the number of adults in every country that have an account at a bank or other financial institution or with a mobile money provider. Over the past 10 years, we've seen a surge in account ownership, mainly driven by digital technology. Literally largest example being India, which opened accounts for over 300 million people, literally winning the Guinness Book of World Records for opening the most accounts in a single month, which is enabled by their national digital biometric Aadhaar ID. Mobile money accounts have also powered progress in sub-Saharan Africa over repeated Findex waves. The technology has spread from East Africa to West Africa and beyond, dramatically increasing the share of adults who use digital payments in addition to having an account. About 1 in 5 adults in sub-Saharan Africa use a mobile money account. Countries like Nigeria and Ethiopia, which in 2017 did not have a supportive regulatory framework for mobile money, were left behind. The development of a mobile payment ecosystem also has benefits during COVID-19, as countries have needed to rush out social protection measures for the most vulnerable populations. In West Africa, where mobile money accounts surged in the past 5 years, Togo built a digital cash transfer program to provide monthly aid to informal sector workers. Despite the challenges of reaching workers without formal documents, the program was set up in just 10 days and reached 12% of the population. We've also seen a surge in the use of accounts to make or receive a digital payment. Here defined as use of a card or phone to make a payment from an account, use of an account to send or receive remittances, receive wage, agricultural, or government payments, or to pay a utility bill. In 2017, about half of all adults sent or received money digitally from their account. In some cases, fintech is helping people benefit from economic opportunities and escape from poverty. A study in Kenya found that the spread of mobile money accounts has dramatically reduced poverty, especially for women. Research in India and Africa have shown that fintech can help women get jobs, control their money, and weaken sexist attitudes. Plenty of studies have found that fintech can help people from falling into poverty. For instance, a study in Kenya found that people facing an economic emergency receive financial help from a wider geographic and social network of friends using fintech on their mobile phone. Fintech can also help people save money. In a new study of low-income migrant workers in Peria, we're finding that mobile phones are typically by far the cheapest and most convenient way to send remittances home. Fintech also makes it easier for people to get paid. They live in remote areas with few physical bank branches. For example, we met piloting the Findex survey. We met a teacher in Zambia who closed the village school for 3 days to travel to the city to collect her wages. She complained that it was costly and dangerous to travel by bus with a wad of cash in her pocket. Digitizing that payment could save the teacher and the government money, plus students could go to school additional days a month. This slide shows how being unbanked overlaps with other forms of inequality. Women and poor people are more likely not to have accounts, for example. So if you're unbanked because you don't have ID, the bank is too far away, small transactions are too expensive, or you don't trust the bank to keep your money safe, it's much harder to pay your bills on time, save money for the future, handle financial emergencies, or invest in business opportunities. You can do those things using cash, but it's much more difficult. More adults are getting access to financial services across the globe. but the pace of progress is highly uneven. According to the latest global Findex data, the share of adults with a mobile money account in sub-Saharan Africa ranges from the low single digits in economies such as Nigeria to more than 70% in Kenya. Nor do differences in financial inclusion neatly line up with variations in income. Among lower middle income economies, the share of adults with an account ranges from about 20% in Pakistan and Cambodia to up to about 93% in Mongolia. So if income doesn't tell the whole story, then what, if anything, do regulations have to do with it? So let's start with mobile money. The circled yellow dot is Kenya, where 73% of adults actively use a mobile money account. The circled blue dot is Uganda, a low-income country where 60% of adults are financially included. Only 33% of adults in Uganda have access to a bank account, but over 50% of adults use a mobile money account. Although most villages in sub-Saharan Africa don't have a bank branch or ATM, mobile money agents and merchants are densely located throughout the region. Now let's look at how good regulations support mobile money adoption. In a new policy note, we use a GSMA regulatory index, a composite score comprised of 6 dimensions and aggregated to assess the extent to which an economy's regulatory framework enables mobile money. We find that mobile money ownership is higher in sub-Saharan African countries that score well on the GSMA index. And the relationship is statistically significant after controlling for different levels of economic development across the region. Specifically, the data show that a 10 percentage point increase in the GSMA regulatory index is correlated with a 7 percentage point increase in ownership of mobile money accounts. This supports the overall idea that good regulatory practices are associated with more adults using mobile money. Next, we try to track down specific regulations that matter most and find significant positive correlations between the index and mobile money ownership, the sub-scores of measuring know your customer documentation requirements, authorization, and consumer protection. It makes sense that these variables would track with higher mobile money ownership. Permissive KYC rules for small, low-risk account holders can enable financial inclusion of the poor, who often lack documentation needed to open accounts. Authorization captures factors like the existence of mobile money legislative frameworks, capital requirements, and the ability of non-banks to offer mobile money services. Good consumer protection policies ensure that consumers are aware of all fees and provide an effective avenue for redress, all of which shore up trust in the financial system. In a second forthcoming note, we update previous research to explore why total account ownership varies so widely among all economies and within similar income levels. We use data from the 2017 World Bank Financial Inclusion and Consumer Protection Survey and find that account ownership and the use of formal savings are higher in economies with more strict and better enforced consumer protections, which give people a degree of confidence that they can transact without being defrauded. We also find that formal savings is correlated with policy to limit fees, as well as tax incentives aimed at fostering financial inclusion. Our analysis comes with important caveats. There is no quick and easy combination of regulations that can unleash financial inclusion, and there are limitations to our analysis. For example, the GSMA's index is only available for 2018, which prevents us from tracking the impact of regulations over time. And it's certainly true that regulations, especially around consumer protection, develop in response to growing fintech market penetration. But these analyses are at least suggestive that a strong regulatory and consumer protection framework and infrastructure is necessary to encourage the use of financial services rather than just their adoption. In particular, to encourage financial inclusion and protect the vulnerable populations that are receiving digital payments for the first time during COVID, regulators need to strengthen and enforce consumer protection. The onus for good financial behavior should not rest exclusively on customers. For example, requiring clear and easy to understand product terms may be especially important for low-income adults, especially women, given their relatively limited financial experience and capability. Lab experiments in Mexico and Peru found that bank customers presented with simplified statements about credit and saving products made better financial choices. A recent mystery shopper audit of microfinance institutions in Uganda found that loan officers failed to provide consistent information on costs, and that inexperienced borrowers got less information than experienced borrowers, and that printed material on borrowing costs were missing or misleading or failed to meet guidelines. Regardless of how financially literate people are, they can make good financial decisions if they're given inaccurate or incomplete information. It's also important to recognize the new layers of cyber risks posed by rapid digitization of payments during COVID-19. Governments need to protect people's digital ID, employers need to secure workers' salaries and other personal information, and fintechs and banks need to make sure that these payments are secure so that low-income adults can access their money and, really importantly, have confidence in the security of the digital system. Consumer safeguards are also important for building public trust in the financial system so that poor adults can use their adults to build financial security. Let me just briefly add one example of one necessary foundation for the financial inclusion infrastructure. Key to building an inclusive digital payments ecosystem are competition and interoperability. The ability to send money or to receive it from another person, even if they use a different financial service provider. Interoperability is good for all users of financial services, but might be especially advantageous for women, since they're typically less likely than men to have multiple phones and SIM cards that support sending, receiving funds via separate payment systems that are not interoperable. Interoperability between mobile money and bank accounts could also make savings accounts more accessible to poor and rural adults. For example, I'm studying a product in Ghana that allows mobile money users to sweep the money into a bank account, which can earn interest and build a credit history to access appropriate credit. Governments should promote competition to digital financial products and services and implement global and good practices to support competition and consumer choice. When financial service providers, whether banks, mobile network operators, microfinance institutions, or financial technology companies, face meaningful competition, they have greater incentive to tailor financial products for vulnerable populations and provide better customer service. And so all Findex data that I mentioned is publicly available at the individual level, and look forward to answering any questions. Thank you.
Thank you very much, Leora. Thank you for a great presentation. Professor Townsend, the floor is yours.
Thank you.
I'm sorry.
So I don't have access, Maria.
Let me see. Lily, can you give Professor Townsend the ability to share his screen?
Yeah, Professor Townsend, you're just going to use the share screen option on the bottom towards the right.
Okay, I got it now. Thank you. Yeah. Thank you very much for asking me to join the panel. I must say I'm learning a lot and very eager to interact further. Hopefully we have time for questions at the end too. So I want to address the call, how financial infrastructure can affect inclusion and inequality, mentioning both physical and digital infrastructure, and come to the policy and regulatory actions that have already been mentioned by the previous panelists. So specifically, how does financial infrastructure affect inclusion and impact inequality? What is the evidence pre-COVID? So I'm going to take that literally and tell you just very quickly some research. So this is going to be pre-COVID. It's historical, and it's going to focus on physical infrastructure, which Camille mentioned banks. And so this is an expansion of banks in a particular setting. In particular, this paper with Yanji Teng and myself, we are fortunate in Thailand to have data on the opening of new branches between 1986 and 2011, almost 1,500 branches from which we define local financial markets. I want to share with you some lessons from the data and the model, and particular focus on identifying the dynamics of this expansion, the transition paths, delays, uneven effects across local markets, and indeed seemingly perverse impact. I don't want to share these with the goal of casting a discouraging note. On the contrary, I'm a big fan, as you will see, of the new technology and efforts to reduce poverty and lessen inequality. But I want to share this because we do not want policymakers to be blindsided to the short-run impacts of the policies. And they're going to have to build a commitment against political pressure as these dynamic systems evolve. It's good in the end, but it takes quite a number of years to get there. So if you look, for example, at the impact of the branch expansion, lots of good things happened, as you might have anticipated. It's associated with a growth of GDP, quite a bit actually. Almost all of it, the model does pretty well against the data, and this growth is attributed to growth in labor as farmers leave and go to a more productive sector, growth in capital as households accumulate wealth and invest, either in their own business or in banks through intermediation. And the model does significantly raise access and lower variation in inequality in credit access. So all those things look great. Now there is an intermediate result, but I think you're familiar with it, which is the Kuznets curve. So the model generates a hump-shaped income Gini, and the warning here is that inequality initially increases, but then it decreases, and the model, by the way, matches the data. So presumably something like this was going on. So as you open branches for the unbanked population, it allows a relatively small number of talented entrepreneurs to access credit that they had not had before and earn more income. So that's the part of the increase in inequality. So Gini is going to deteriorate in some sense, be higher in earlier years. Eventually, there's an increasing demand for labor to work in those firms and set up new businesses. And this pushes the wage up as initially farmers leave the agricultural sector, but it's not enough. There's a shortage of workers driving that increase in the wage. And so ultimately, Gini falls. So be prepared for these kinds of dynamics. And expect the policies to take a little while to reach wider beneficial effects. It's actually a bit worse, although I don't want to dwell on it. If you focused on the average wage in an economy, it actually goes down. The reason being there's a selection effect. As farmers who were previously earning less join the labor force, their wage is lower and it's averaged into the whole, lowering the overall wage. And these pressures that eventually increase wages do not happen uniformly across the country. Eventually, yes, but the takeoff point is different for different points in space. So if you looked across markets, you would see income inequality going up. And there are large welfare gains, as I've been saying, but it takes a while to get there. Okay, so as the previous panelists have been discussing, Luiz and Leora, we could think about digital banking and digital payments. As in Brazil, the PIIE system that the central bank has been initiating, but also India and other countries that the panelists have mentioned. So through the lens of the Thai model, we kind of do a what if experiment. What if in 1986, Thailand had the digital currency? I know that's, and digital banking, that's of course unrealistic. But the point being, we can now compare what actually happened to Thailand and through the lens of the model relative to this new version where we really don't need physical bank infrastructure anymore. So as anticipated, introducing digital banking does eliminate much of the regional heterogeneity, and it does so really quickly. However, given the other aspects of the model, wealth accumulation, slower transition into business, and so on, there are impacts that take a while to materialize. We can even in this way think about central bank digital currency. Suppose, given the model, we replace all the paper currency in the model with interest-bearing accounts, essentially by making the transactions cost of the branch zero, because you really don't need branches at all for this, since you can do it electronically. This does eliminate currency from the household wealth portfolio, which had been otherwise held for consumption smoothing, and it does increase welfare. However, at the calibrated parameter values, the impact is rather modest. We can compare that to the other electronic aspect, namely digital credit, lowering credit costs to zero in the initial year while letting the branches expand on the savings side. the opposite of the first experiment. So this removes currency by entrepreneurs to self-finance. They don't need to do it that way anymore. And this has a much larger impact. So taken at face value, we could say that if countries were like Thailand, the rise of digital banking, the larger impact will be on the credit side rather than on the savings side, but payment side. But I caution to add that there's actually complementarities. If you take the sum outcome of these two experiments independently and add it up, it is less than the total, because I guess it's intuitive. Through intermediation, the savings side is interacting with the credit side. So we really do need both, but at least we can think about aspects of central bank digital currency through the lens of these structural models, as well as considering the dynamics and so on. I want to say also that, model building, it matters what you put in, and you really have to be careful. It's not like there's one obstacle that fits all heterogeneous populations in all countries. So this work with Luiz and Sal, as well as Dabla and Yanchi, we distinguish the constraints on financial inclusion. There's financial access costs, collateral costs, bank markups that have to do with costly verification. All three ingredients are in the model. The question is, which fit best, or which combination fit a given country that's contemplating policy changes? It's actually hard to tell from the data what the most binding constraint is, and you're easily misled by the data into the wrong one. So you do need the structure of the model with the data to figure out what the constraint is, and hence what the impact is going to be. If you choose the wrong constraint, focusing on the wrong policy, say lowering collateral constraints in a country where the other constraints are more binding, the policy is going to be less effective, and financial inclusion measures will not achieve the goal nearly so efficiently. So the point of this is research is relevant. At least you worry a bit implicitly that this is an academic just promoting research. I do want to reassure you, the goal here is to have a beneficial impact on policy. And this paper in particular, through the IMF, jointly with MIT, was adopted and used by the country desks in various countries to sort through the various strategies they could use to increase financial access and promote growth. Another question that was posed to the panelists: how did financial infrastructure attenuate or exacerbate the impact of COVID on vulnerable households? This is something in the US that Camille addressed, and my points just replicate what she said, that Fed Main Street and paycheck protection programs rely on commercial banks, and hence on the relationships they had with their customers. It was really very difficult to target efficiently to key small and medium enterprises, say, that have a pivotal role in supply chains and flow of funds. So we have a problem in relying on legacy information and financial infrastructure. In the US, it is quite limited, and the virus, as Camille said, had the consequence, among many other, of revealing this chronic gap in the information and financial infrastructure. So the question then is what to do, which measures could central banks take to better support vulnerable households, not simply in the recovery, but in longer term through financial infrastructure. So there's a list of 5 things here, and this is an agenda for the US. Contracts, say between a bank or a financial institution, including fintech and an SME, those are the objects traded. We need innovation there to not rely exclusively on relationship lending, but to use the technologies available now through programmed smart contracts to automate things, and using the tools of cryptography to enable the necessary security for strangers to deal with each other, not just for people with previous relationships. Securitization is important, a very needed innovation. Here again, partial information is probably the best way to go rather than going for a full privacy versus full disclosure. And cryptography allows these combinations to be part of the optimal securitization design. I think database infrastructure is key. The creation of it, the access to it, and the use of it. We need to utilize existing data, organize better across existing data sets. You can see people really being very creative to track the impact of the COVID using this or that data set, but they're not necessarily all consistent with each other. Probably need to create new data as needed, and particular link to electronic transactions so we get more in real time. Data are inherently a public good, as was mentioned earlier, although we do need to respect the privacy aspects and provide incentives for participation. Multi-party computation allows encrypted line items of financial accounts of firms and banks to be aggregated up for analysis while totally preserving privacy. So again, what I'm arguing for here is to take advantage blueprint, which is not traditional, rather takes advantage itself of the new technology. So thank you very much.
Thank you so much, Rob, for a very interesting presentation. Now there are some questions from the audience, so I'm going to try and read and direct to each of you. And maybe I will first read the questions to each of you and then get each of you to respond after I've gone through all the questions so that we can better utilize the remaining time. So there's a question from Pierre Monin for you, Luiz, and he's asking sort of how can new fintech solutions help central banks reach directly low-income households and thus avoid loss of monetary policy transmission through financial wealth effects. There's a question to you, Leora, about whether there are any countries that have used the pandemic as an opportunity to put in place regulations that have particularly benefited women who have been disproportionately impacted, and what is the one of the top regulations that countries should make sure to put in place. Camille, there's a question to you about what can the Fed do differently to support poor households going forward, given the limitations of, I'm adding this, but given the limitations that you noted of the response so far. And then Luiz, to you as well, the recent evidence seems to indicate that deeper financial systems help reduce poverty and inequality in developing countries, but also that rising inequality, there's rising inequality in various financially advanced economies. What could be the solution for the latter? How can we make deepening of the financial markets more equal? And what's the BIS thinking on this? And let me throw in a question of mine for Rob. You discussed the potential impact of CBDC, of a central bank digital currency, through in particular the savings channel, let me call it that way, but what would happen if that CBDC does not pay interest, right? Many of the central banks that are discussing CBDC are not thinking that their CBDC would pay interest. So would we see any benefits from CBDC in that case? So let me just open it up to each of you in the order that you spoke so that perhaps you can address these questions, and then we'll see if there are more once we're done and hopefully stay within the time frame. So I'm going to ask you to be as brief as possible, starting with you, Camille, because we have
great.
10 minutes
So
left.
the question that I'm asking is, what else could the Fed do to target inequality? And thanks for the question. So I think in addition to what Rob mentioned, I would mention 3 other things. The first is, as everybody knows, mobile money is lags. The use of mobile money lags in the U.S. compared to the rest of the world, and certainly there could be advances there. And I think the Fed could lead the charge with other regulators, and that would, of course, be subject to the appropriate kinds of consumer protections with respect to conduct and data privacy, et cetera, that Leora mentioned. I think number 2, and this relates to Luiz's presentation, I think there's certainly a very orthodox view, I think, in the U.S. of the kinds of targets that the central bank should have. And I also think it's possible for the central bank to think about other targets, such as focusing on labor participation rates for particular groups. So in the US, the labor participation rate for Black males is extremely low. And if you were to target that, a number of other kinds of policies would have to be put in place in order to make sure that that target would reach the appropriate levels. And I do think there's scope for the Fed to do something like that and get the ball rolling. Third, I think has to do with the way the transmission mechanism depends very much on the value of assets, particularly household assets. In the United States, and this is very peculiar to the United States, there's a long history of discrimination around housing assets. And so you can have homes that are identical but owned by Black households or white households, and those will be valued very differently. And so I think there's a role for the central bank to play in researching how to create equality among those assets so that the transmission mechanisms tend to work better in the long term. And I'll stop there.
Thank you very much, Camille. Luiz, you want to come in on your questions?
Yes, so, well, thank you, Pierre and others for the question. I think what we are observing is in terms of financial technologies and infrastructure helping to reach directly poorer households and SMEs is the various issues that we discussed, and Camille, Leora, and sort of Bob mentioned. The technologies in terms of virtual banking, digital ID, using big data to improve credit ratings, the role of platforms. I think all this is contributing to increase the speed, fast payments, PIIs. All this is contributing to increase financial inclusion and the speed of transformation. Now, what I think Professor Townsend mentioned is important. We need to move beyond the sort of natural Kuznets initial effect, which would be benign. I mean, if you do have a Kuznets curve that sort of goes up but then quickly goes down with financial inclusion and all these technologies, that would be a sort of a collateral effect that we could admit. The problem is if these technologies bring more segmentation in terms of market, and it brings actually in the long run, in the medium long run, more inequality that sort of builds in. So I guess the policies that we are all thinking about is really to make the technology really a public good, to favor a level playing field, so that the access to the technology is widespread, and sort of the cost of accessing the technology is lowered on a permanent basis for lower households. And I think this goes hand in hand with what Camille was suggesting, is that by doing that, you do improve the transmission of your policies, both on the monetary side, but also on the fiscal side, because you have more capacity to diversify the instruments with which you are taking policy action. And if on top of that, you are coordinating them in a more targeted way, but at the same time in a more efficient way and with more speed, that's a win-win for society. I think that's what we are all looking for. It's this combination of having the technology, the infrastructure as a public good, a widespread dissemination of these positive externalities, a better way to target specific groups, and therefore you are at the same time augmenting the macroeconomic effect of the transmission, which means all your fiscal multipliers and also your consumption effects and so on and so forth, while at the same time you address the right pockets and the right groups that need to benefit from these policies. So that's a kind of win-win that regulation and the action of policymakers should be targeting. And I think it's possible. It's a matter of, let's say, really making sure that we understand the transmission mechanisms, really we have the right tools, and really we activate them on time.
Thank you so much, Luiz, for that intervention. Leora, do you want to address the questions that were posed to you?
Thank you. The question around how to target, whether policies are targeting women. So we know the World Bank's documented hundreds of COVID-related relief programs. We don't yet have a good mapping of whether the payments have been made in cash or digital, and it seems that in many cases, mixes are being used. But certainly, we are learning what's important for the successful shift from cash to electronic payments, so both transfer payments, but also, as I mentioned, salaries in the apparel industry, factory workers, in agribusiness chains as well, from tea pluckers to other farmers. So, requirements are, for example, to ensure that agents and merchants who provide cash out services are deemed essential businesses during any lockdowns. That banks are available and lenders to provide liquidity to these cash out agents and we know that merchants' sales are falling and are hoarding cash, and there have been liquidity challenges. And again, to reiterate the importance of consumer protection, especially when we're digitizing payments to the most vulnerable populations, to ensure there aren't predatory fees, for example. And then certainly, and even more so in the case of salaried workers, to make sure the regulatory and tax policy supports merchant payments so that people have the option to keep their money electronic. Thanks.
Thank you, Leora. Thank you so much. Rob, you want to come in on the question on CBDC?
Yeah, sure. Thank you. So through the lens of that model, the CBDC in terms of currency, the benefits coming from twofold, really. One is just easier to access financial infrastructure, so that cost disappears, and that's a benefit. And it is also true that the incentive to do things through the bank has to do with the interest rate, as opposed to if you equalize the rate to zero, the same as currency, then there's really no portfolio advantage. So you're correct. However, I think we need to think more broadly about CBDC. It's used quite generally. In fact, I'm afraid often introduced as a concept in experiments or in reality without thinking through all the potential of the technology. So if you think about the potential to create better financial infrastructure through programmed contracts, then lots of good things can happen. The credit aspect in the model is only one of them. In general, one could do much more. I mean, back again to the financial accounts, sort of the ledgers, Bitcoin, blockchain, and the ledgers. The ledgers are accounting ledgers, which sound boring, but it's a way to organize data. So thinking about improving the information infrastructure in the US through the lens of what we've learned, in computer science and so on about asynchronous and synchronous access. And again, the cryptology aspect of Bitcoin is much more general than just that coin. It's a widely available technology, fully homomorphic encryption and multi-party computation, and that can be part of building a better infrastructure. So I'm not negative about CBDC, but I think it's really important to rather than thinking about a technology, now what do we do with it? And it's the other way around. We think about the economic problems and we grab the relevant pieces of the new technology to help solve those problems.
Thank you very much. And we are right on time. I want to thank the panelists for excellent presentations and interventions to answer the questions from the audience. And I also want to thank the audience for being with us this morning and sharing some of your questions. So with that, I'm going to bring the session to a close. And thank you, everyone, and hope you have a wonderful rest of the day. Thank you, Luiz. Thank you, Rob. Thank you, Camille. Thank you, Leora.
Thank you. It's been a pleasure. Thank you.
And thank you, Lily, for helping us with technology.
Thank you.